Okay, this week's market outlook. Starting with the summary. Last week, we saw US oil move lower as markets began pricing in the possibility of an extended ceasefire, and as a result, the majority of short end yields softened throughout the week. However, both the US 2-year and the Swiss 2-year remained relatively resilient compared to their peers, which is important to keep in mind from a rate differentials perspective, how the Swiss and US short end was less affected than, for instance, Europe or Canada. At the same time, equities continue to grind higher, reinforcing the idea that overall market sentiment remains firmly risk on for now. So if we go to the calendar and we look at the events for next week, starting on the Monday. Monday's pretty quiet. We don't have anything major. So is Tuesday, and then the first real big print is going to be on Wednesday. That being Australia CPI, which is forecasted to come in at 4.4%, obviously 20 basis points lower, however still way above the 2% target of the RBA. And then we also have the RBNZ press conference, which is a consensus hold for now. So that's Wednesday. Thursday, we've got some ECB speeches from Lagarde and Lane. To be honest, a lot of the rhetoric out of the ECB has been rather hawkish from a lot of their members. A June hike is priced in at around 90%, so that should continue to be hawkish. However, last week's PMIs could actually mean we see a slight more dovish twist to them. Then we've got the US GDP quarter-on-quarter estimate, which is forecasted to come in at 2%, which is great for the dollar. We then have some durable goods orders, PCE as well. Some speeches by Fed Williams. Then come to Friday, we've got unemployment in Japan, expected to remain the same at 2.7%. GDP in Canada, and that's essentially it for this week, data-wise. So yeah, that's everything we're looking at this week, the main events data-wise, and let's get into the currencies. So starting with the US dollar, nothing has really changed from last week. Obviously, US short-end yields are back near yearly highs at 4.132%. That's where I believe they closed, which is supporting the dollar on rate differentials. And as I mentioned, what's interesting is the movement in short-end yields, even with US oil taking a hit from the Middle East optimism. So it kind of really does tell you how the markets are positioning short-end wise. They don't think that this hawkish pivot in the Fed is going to vanish as soon as the Middle East conflict dies down. It looks right now at least like it's going to stay. Therefore we expect to see continued US dollar strength driven by resilient US growth and sticky inflation. PMIs last week out of the US were extremely positive, with manufacturing PMI, S&P Global this is, coming in at 55.3, showing price pressures mounting at quite a fast pace, obviously keeping the inflation threats very elevated, especially since it came in at 3.8% last week, I believe. Looking at the institutions, if we look at the US, so we know that Credit Agricole are bullish on the USD. Yep, long USD here from JP Morgan and Goldman Sachs as well, if I can find that one. And yes, here we are. Goldman Sachs are also bullish on the US dollar. So yeah, and then actually we can also see asset managers building up their long dollar positions. If we come down into the CFTC report, yeah, we can see from last week, the week-on-week net change has been 6,000. So we've seen asset managers actually increase their dollar exposure. So yeah, we are bullish on the dollar this week. Moving on to the pound. So the pound found some support last week, driven from the UK's cooling long end of the curve. So much so that markets have repriced the initial pound sell-off driven by the Andy Burnham challenge 2 weeks ago. However, that doesn't mean the political uncertainty has vanished, it's just quietened down for the moment. And albeit it is still a major risk for the pound in the near term. However, now that's been repriced, I think the short end of the curve is going to start to weigh on the sterling. Last week's data releases, being obviously the labour market report, CPI and retail sales, all disappointed to the downside. I believe retail sales came in at minus 1.3%, something like that. And obviously this is going to just lead to a less hawkish BOE, with institutions now only pricing in around one rate hike, that being in June. Therefore, I think the short end being pressured to the downside following weak economic data and political risks still in place puts the pound in a weak position. And I mean, if we look at the institutions, they are overwhelmingly bearish as well. If we look at who are the main ones, Goldman Sachs are bearish on the pound. Yep. 20th of May, Goldman Sachs are short on the pound. If we look at UBS, they are short on the pound as well. Here we are. And Credit Agricole as well. Should be here. Yeah, short GU. So institutionally, it is quite a consensus move to the downside for the pound. Obviously, I think Credit Agricole was citing a fragile political backdrop and real economy weakness, obviously adjusted for inflation. So yeah, bearish on the pound this week. Moving on to the euro, we are neutral and we think it's very dependent on the cross. So I mean, the short end of the curve in Europe took a slight hit last week following weaker than anticipated data, specifically PMI, which showed a clear deterioration following elevated energy prices. Specifically manufacturing PMI, which slipped into contractionary territory. Obviously that means below 50. This, coupled with softer US oil prices, has resulted in short-end yields retracing by over 4% last week, which has hurt the euro for sure. ECB rhetoric remains hawkish. Just this morning, I was reading these headlines this morning, ECB member Kocher, or however you say it, states that the ECB faces pressure to hike as Iran war feeds prices. So they're seeing clear inflationary pressures from the Middle East. And another ECB member also stated that an ECB hike may be inevitable to keep credibility. However, a June rate hike is already priced in at around 90% according to money markets, as we can see here, 87.2%. So yeah, I mean, upside will be limited because it's already priced in. But yeah, so that's essentially why we're kind of dependent on the cross. And I mean, even institutionally, Credit Agricole are bearish on the euro due to subdued growth in US tariffs, whereas Morgan Stanley are bullish due to increased hedging flows. So even the institutions are quite divided at the moment. So it's all dependent on the cross. Crosses, I would trade this, euro pound, and euro AUD. Obviously, long euro pound, short euro AUD. Those are and short euro dollar, of course. Those are the main three I'd kind of be looking to get in on. Moving on to the CAD. The CAD is quite a quick one this week. It's obviously no doubt going to get hit from the softer US oil prices and yields retracing. And there's not much else to add really. It's entirely US oil driven, which is all dependent on how the current negotiations go. I mean, you can get really caught up in the headlines. So personally, obviously I read them, but I don't put a lot of weighting on them. I put more weighting on the market reaction. So look for the reaction functions on US oil. That's going to tell you what markets are pricing in and what narrative the markets are actually running with. So yeah, that's kind of all I have to say on the CAD. Even institutionally, Barclays Bank are neutral on the CAD, whereas Deutsche Bank are actually bearish due to Canada's lackluster economy and softer US oil prices. So I'm just neutral. I don't really want to go near it, for longs at least. Moving on to the Australian dollar. So the Australian dollar definitely caught a few people out last week. It caught me out on a GA position. But we saw a slight dovish repricing across the front end of the curve in Australia last week, driven from the weaker than anticipated labour market report, which saw the unemployment rate tick 20 basis points higher. I believe we're now at 4.5%. However, the short end is stabilising around the 4.6% level, and with inflation next week forecasted to come in at 4.4%, albeit 20 basis points lower, but still super elevated. I think we can expect to see the short end push slightly higher. Not to mention the Chinese yuan is continuing to find strength, and so are equities, keeping high beta currencies supported. And then institutionally, JP Morgan and ANZ remain bullish on the AUD. So JP Morgan, bullish AUD. Give it a pause, you can read it, but essentially it's related to FX hedging flows. And then, who else? ANZ. ANZ are also bullish on the Australian dollar. I wouldn't trade AUD USD personally, just because for me it's strong versus strong. But something like pound AUD, euro AUD makes a lot of sense for me. So yeah, that's essentially where I am at on the AUD. Moving on to the New Zealand dollar. Yeah, so the New Zealand dollar. I am neutral this week. So obviously, next week we have the RBNZ, or this week I should say, we have the RBNZ rate decision, which is at the moment a consensus hold, as you can see here, 96.4%. So it's pretty much expected. So yeah, yields across the board are softening on lower US oil prices and a potential extended ceasefire in the Middle East. Lower US oil prices are actually going to benefit New Zealand due to them being mass oil importers. So if optimism creeps up, expect to see strengthening New Zealand dollar. Also add in China flows, add in equities movements. There is definitely a case for being long on the New Zealand dollar. However, I think the major catalyst next week is going to be whether the RBNZ come across more hawkish than expected or more dovish. It all depends on that meeting, which I believe is on the Tuesday. No, the Wednesday, sorry. Yeah, Wednesday. We can see here, RBNZ rate decision. So going into the Wednesday, we could probably expect the New Zealand dollar to catch a bid. And then Wednesday onwards, it's all dependent on how the meeting goes. Institutionally, if we go and look at what the institutions are doing, we can see that Deutsche Bank and Credit Agricole are actually bearish. Deutsche Bank short New Zealand and Credit Agricole short New Zealand dollar. And then JP Morgan are actually neutral, as we can see from this insight here, neutral New Zealand dollar. So yeah, neutral on the Kiwi for me, and let's get into the yen. So to be honest, the yen's been quite a nice pair to trade over the last 2 weeks, obviously fading the intervention because the macro fundamentals haven't changed one bit. And I'm looking to do the same this week. However, as we edge closer towards the 160 handle on UJ, we need to be extremely careful. I probably wouldn't add any more positions at the current level. I want to pull back. Yeah, I mean, the closer we get to 160, the higher the intervention risks become. So it's kind of like, why would you want to fight with that? We've obviously got a June rate hike priced in at around 86%. However, I mean, that is clearly doing nothing for the yen. Their base rate is still super low. And the domestic politics and fiscal policy is incredibly negative for the yen. So yeah, macro points to the downside, but we need to get in on the pullbacks because intervention is definitely increasing as a risk. Moving on to the Swiss franc. So we are bullish on the Swiss franc. I feel like the Swiss franc we're flipping bias every week because something always changes. But last week's obviously softer yields is great for gold and the Swiss franc, and obviously last week's softer yields derived from lower US oil prices helped the Swiss franc catch a bid. And then the short end is also holding up better than 80% of G8FX, obviously due to growth prospects supporting the franc. And institutionally, Credit Agricole, they're bullish, and so are JP Morgan, who are citing real money and systematic buying of the Swiss franc, which if we come here, Credit Agricole, long positions on the Swiss franc, and same with Nomura as well, they're long on Swiss yen. Was it JP Morgan? Oh no, JP Morgan are actually short on the Swiss franc via the dollar and AED, which I kind of agree with, to be honest. AED Swiss upside makes sense, and dollar Swiss upside makes sense, but it's all just about getting in at these key levels. So yeah, that is essentially this week's macro breakdown. Now let's get into the technicals. So starting off with the dollar, I think this level is going to be very nice here. The 99 handle just above it, we've got a lovely demand zone there. So yeah, I'm looking for upside from this level here. Now if we go down into the different pairs, starting off with GA, I think this is a great level to get in at. If we end up breaking this level, I want to get in at the 109.25. Yeah, around the 109.25 for shorts. And yeah, this makes sense, targeting a 1 to 2. GU, I want to kind of see a bit more of a shift in structure. If not, I'd probably want to get in at the 1355. But I think this makes a lot of sense for this week. Dollar Swiss, I think if we don't get in from this level is going to be a very nice area to get in at. Maybe extend the stop below those two for a 1 to 1.5. Something like that looks nice. Dollar yen, as mentioned, it's been a very nice pair. Like so many entries you could go in here. One there, one there, one there. But yeah, looking for this to hit about this week, 159.39, and I think anything near the 160 is going to be too risky for me intervention wise. Euro dollar, I like this level here for shorts. Cleaner looking than GU for sure. Euro pound, I got caught out by euro pound last week. I think this level here is going to be nice. 8625 for some longs. Euro Swiss, what happened last week? We called, I believe we called something like this to happen, which did happen. However, then it got reversed. Looking for shorts around this level here. No key handles really near it. There's not really a key handle near it, but I think this level here looks very nice for shorts. Euro AUD, I want to get in shorts here at the 16325 on the dot almost. If I mark that out, 16325, I believe. Let's have a look. Yeah, literally on the dot. AUD NZD. Shorts here look, longs here, sorry, look great. I'll definitely get into these. 1215 handle as well. Perfect confluence. AUD yen position came in nicely last week. Could have entered again. 1 AM. But if you had limits, you probably would have got in there. 113 still looks like a very nice level where a lot of these funds and institutions are buying up the Australian dollar against the yen. CAD Swiss, I'm looking to get in short here. CAD Swiss start of the week, our position hit take profit, which is quite nice. Swiss yen, I think this level here, 201.67 looks nice. If we just move that over. Something like this. And then dollar CAD, these two levels. G Swiss, this level here. Quite a big watch list this week. AUD CAD, I want to get another 9775. And then ES, we got a nice bounce on this level here. I'm expecting the bounce to continue from the 744. So yeah, that is this week's technicals and fundamentals. As always, there'll be a discount code in the description for the terminal I use, and we'll catch you in the next video.